Are you an investor who's looking to build a well-diversified stock portfolio based on your investor profile, but you're left wondering what stocks, REITs, dividend stocks, bonds, and other securities are worthwhile adding to your portfolio? Well, if that's the case, ETF investing might be an awesome option for you as an investor, and I'm here to break down just how you can go about starting your very own ETF portfolio. Hey, what's going on, savers and investors? I hope you're all having a fantastic day and that you're either buying or preparing to buy some stocks while the stock market is trending red right now. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be looking at a slight variation on the highly popular dividend stock portfolio that we looked at a couple weeks ago. If you haven't already checked that video out, then make sure you do after today's video. Today, we're going to be looking at how you can go about creating two different portfolio scenarios based on your investor profile and your risk tolerance, but this time exclusively with exchange traded funds, or ETFs for short, instead of going about picking and choosing your own stocks, dividend stocks, REITs, and other securities. Now, personally, I hold both ETFs and individual positions in my portfolio because I like to have a mixture of both, and I also like to actively manage a portion of my portfolio. That's why I go about picking and choosing some positions and securities in my portfolio. However, if you're an individual who honestly just doesn't want to take the time to pick and choose your own positions, do research, and constantly be on top of the market and what's going on, then investing with exchange traded funds is probably one of the best options that you could go for. What we're about to see in today's video is essentially what these robo-advisors such as Wealthsimple, Milo, and Questrade portfolios are providing as a service to investors who might not be knowledgeable about the stock market and really just want an easy way to have a low-cost, hands-off, diversified portfolio. I've personally used these robo-trading services in the past really just to see what they were about and how they would construct a portfolio for you. And for an individual who really does just want to have that hands-off approach, I would recommend these services. However, in today's video, we're going to be looking at an in-between of this fully hands-off robo service or being more active and picking and choosing really your own specific securities. We're going to be looking at the construction of a stock market portfolio based on exchange traded funds exclusively with different weight allocations for different asset classes based on your investor profile. So with that said, before we do actually go about diving into those two different portfolio scenarios, let's actually briefly discuss why this strategy of using exchange traded funds exclusively could be a good option in the first place. First off, an ETF allows you to buy and hold shares of a fund which itself is going to be holding multiple different securities, sometimes even in the hundreds or thousands of positions. So by holding one single share of an ETF, you're instantly exposing yourself to a variety of different securities and instantly diversifying your portfolio without having to go about picking and choosing your own securities, which can not only be very time consuming, but also difficult. The second benefit of ETFs really goes hand in hand with that instant diversification we just looked at, because by holding multiple different positions, even though you're holding only one single ETF, it itself is going to have multiple securities within it, and for this reason, you're going to be significantly diminishing the risk of your portfolio. It's a pretty simple concept actually. If your portfolio has 5 different stocks and 2 of them go down in value over the course of a month, let's say, well, you're going to be highly exposed to the fluctuations of those 2 positions because you only have 5 positions in your portfolio, versus in contrast to this, if for example you were holding one ETF which itself had 500 positions in it, well, let's say 40 of them take a hit in the short term, you're going to be less exposed to the fluctuations of those securities because there's a lot more securities within that portfolio which can smooth out your returns in the long run. The third advantage of utilizing ETFs over, say, a mutual fund, for example, is going to be their management cost basis, which are typically much lower than, say, a mutual fund. Personally, I like to invest in ETFs that have a management expense ratio of below 0.6%, and typically they're actually even less than that at 0.2% or even 0.08%, which is just so low compared to, say, a mutual fund, which typically is going to be taking a 2% fee straight off the top, regardless of the returns of that fund for the year. And finally, the last main advantage of utilizing an ETF-based portfolio over, say, an actively managed stock portfolio where you're really going about picking picking and choosing every position is going to be the high level of passivity that inherently comes with this strategy of portfolio construction, which I guarantee for most of the investors watching this video, passivity is going to be a high priority for constructing your portfolio. Many studies have actually even showcased that professional stock pickers who are paid to pick and choose stocks with the sole purpose of trying to beat the overall returns of the stock market have failed to consistently beat the stock market returns on a year-over-year basis. So if professional stock pickers who are paid to do this can't even beat the stock market every single year on a consistent basis, then why should we as retail investors only solely focus on individual positions? It's probably going to be much more advantageous to hold a variety of ETFs. And if you want to dabble in individual stock picks, which yes, I do myself, you can go about watching my other videos where we go over individual stock picks and do research for yourself. So that's just it. As mentioned before, today we're looking at two different portfolio examples constructed solely with exchange traded funds, starting with a more bullish portfolio, which is going to be more heavily weighted towards equity ETFs, which means ETFs that hold individual stocks, REITs, or other equity positions. Now, obviously, at this stage in the game, it is really crucial that you self-reflect on your investor profile and take into account things as, for example, your financial situation, your risk tolerance, your goals as an investor, your age and time horizon, as well as a bunch of other factors to really pinpoint what type of portfolio you want to construct, whether it is either a growth portfolio, a more balanced, or a conservative portfolio. The split of distribution for each different security class is going to be different based on what we just spoke about. All right, so back to that ETF portfolio. In this particular case, we're going to be splitting the portfolio into 6 different types of ETFs, with 5 of them being focused on equities and then 1 of them being focused on fixed income. This portfolio construction strategy is going to be more appealing and somewhat more advantageous for, let's say, a younger investor or just someone who has a longer time horizon in front of them, because historically speaking here, equities are going to outperform fixed income securities over the long term. So if you have a longer time horizon of say 20, 30, 40 years ahead of you, then typically you're going to outperform a portfolio which has a higher concentration of fixed income. We're going to start off with a 30% portfolio weight being allocated to an S&P 500 tracked ETF, which is essentially going to be exposing you to the 500 largest companies in the American stock market, all with one single ETF holding. If you're Canadian, some low-cost ETF options to consider here would be either XUS or VFV, and if you're American, some ETFs to consider for the S&P 500 on a low-cost basis would be either SPY or VOO. Next up, I'm personally quite bullish on real estate investment trusts, and for this reason, I like to hold a fair amount of REITs in my portfolio for further diversification. After all, real estate is really its own industry, and then also for increased dividend income. Typically, real estate investment trusts have a quite high dividend yield. So for this reason, a 15% asset allocation in a real estate investment trust ETF could be a good option here. If you're Canadian, some good REIT ETFs to consider would be either VRE or XRE, and as an American, you might want to look in to VNQ or SCHH. Following REITs, this next position is also going to be an equity position, and this time it's either going to be a split between the NASDAQ 100 or the TSX 60. Honestly, you can pick whether or not you want to invest more heavily in the TSX 60, which typically is going to have a lot more of bank, financial, and energy utility stocks, versus the NASDAQ 100 is much more focused or contains at least a lot more tech stocks. So depending on what you're going after here, you can kind of decide whether or not you want to weight more heavily either TSX 60 or NASDAQ 100. Even if you're American, for example, you might want to just put this position in NASDAQ 100. So we're looking here at around a 15% 10% stake in this portfolio. If you're Canadian, you're going to want to look at XIU for the TSX 60 and then HXQ for the NASDAQ 100. And if you're American, take a look at QQQ for the NASDAQ 100. Following that position, I personally believe that for further diversification and exposure to markets outside of North America, it can be a good idea to go ahead and purchase a foreign security ETF. Once again, nothing too major here. A 15% position could be an ideal amount, but once again, make sure that this fits with your own criteria as an investor and fits within your global strategy for your portfolio. An ETF to look into for this category, if you're Canadian, would be XEF, and if you're American, look into IXUF or VEA. Now, for this last equity ETF, you guys all know that I am a fan of dividend positions, so what would this portfolio be without a bit of dividend stocks? Options to consider for this category, if you're Canadian, would be VDY or XEI, and if you're American, take a look at VYM or HDV. So at this point, if you're keeping track here, these equity positions sum up to 90% of this overall portfolio, leaving us now with 10% left over to invest in fixed income. And in this particular case, we're going to be investing in either a government bond or aggregate bond ETF. And some notable candidates, if you're Canadian, would be either ZFL or ZAG. However, if you're located in the United States, then take a look at EDV or VGLT. All right, guys, that pretty much sums up that first ETF portfolio for an investor who's a bit more bullish on equities and wants that potential for long-term growth. What do you guys think of this portfolio split? And if you have any recommendations as to ETFs that you guys currently have in your portfolio, then comment down below. I'm super interested in knowing, and make sure to smash the like button. Now that we've gone over a nice example of an ETF portfolio that's tailored more for an investor who's looking for growth, what happens if you're an investor who's still interested in having somewhat significant exposure to equities over fixed income, but you'd like to have more of a balanced approach rather than having, say, 90% of your overall portfolio being invested in equities? Well, for this portfolio scenario, we're going to be sticking with the same individual ETFs that we covered with the last portfolio. However, where it differs is going to be the weight that we associate to each one of these positions, and then we're also going to have a bit more of a focus on dividend stocks as well as fixed income ETFs. For the first position in this more balanced portfolio, we're still going to be sticking with an S&P 500 index ETF, but this time we're going to be allocating 25% of it to this position. And by the way, for the sake of the length of this video, I'm not going to be going over the names of every ETF again, so if you need to reference back, either skip back in the video or I'm leaving all the names down in the description of this video. For this next position, once again, we're going to be looking at either a TSX 60 or a NASDAQ 100 position. As an investor, you can go about choosing what fits with your overall goals more, but we're going to be looking at a 10% position here, followed by the real estate investment trust position, which I personally believe is still important to have for further diversification. And overall, I just like real estate investment trust, but we're going to be putting a 10% position here rather than 15% in that growth portfolio. Next up in the portfolio is going to be those dividend stock positions. We can't forget about those, but this time it's going to be a 20% equity stake to really have some more dividend income coming in and steady growth of the portfolio. With this portfolio being a bit more conservative, the foreign investment ETF position is going to be lowered slightly down to 10%, and then the fixed income position is going to go from 10% to 20% and split between two different categories of fixed income. In this case, we're going to be splitting that 20% into 10% for an aggregate bond ETF, such as, for example, VAB or ZAG, and then the other 10% is going to be allocated to a government bond index, such as ZFL. All right, guys, so that pretty well sums up today's video. I want to know down in the comments what you guys think of these different portfolio splits and whether or not you guys hold individual ETFs in your own portfolio. Let me know down below what your strategy is with your portfolio. If you're interested in discovering some more stock picks, then make sure to check out the video right here. And if you want to learn more about some different ETF picks, then the video right here is what you're looking for. So on that note, thanks a lot for watching as always, and I'll see you in the next video.